are in best of your health, both physical and mental. This is Ritika and we are doing corporate issuers. And we are doing the third and the last learning outcome of this reading, that is organizational forms, corporate issuer features and ownership. This learning outcome requires us to compare publicly and privately owned corporate issuers. The main objective of this topic is to be able to distinguish between publicly and privately owned corporate issuers. I know some of you confuse publicly and privately owned corporate issuers with public and private limited companies. So just to clarify, publicly owned companies are those whose shares are listed and traded on stock exchanges. This means that anyone from public with money to invest can purchase or sell shares of these companies. It's worth noting that most private companies are privately owned. However, some public companies may also be privately owned if their shares are not listed on stock exchanges. Therefore, private companies or private limited companies are privately owned, but public limited companies may be privately owned or publicly owned depending on whether they have their shares listed on the stock exchanges or not. The classification of a corporation as publicly and privately owned corporate issuers is determined by the following three factors. The first one is exchange listing, liquidity and price transparency. Second is issuance of shares. And third is registration and disclosure requirements. We'll now discuss these factors one by one. So let's begin with exchange listing, liquidity and price transparency. Publicly owned corporations are usually listed on stock exchange. This aids frequent transfer in ownership of shares. And since the shares are divided into very small units, any investor who's willing to make only a very small investment can also easily purchase and sell the shares. Plus, you also have a place where you can buy or sell the shares easily and find other buyers and sellers. And for privately owned companies, the shares are generally not listed on the stock exchange. The shares are purchased through private placement memorandum or PPM. The transfer of shares is also a very cumbersome process. You must first find the buyer for your shares. Then only if the company agrees, the transfer of the shares can take place. It should be noted that the company may sometimes disagree with the transfer of shares also if they do not want dilution of power, etc. Now for listed companies, the pricing of shares is also transparent. It is usually the current trading price whose information is available all the time everywhere, and this helps the investors to track the value of their investment as it changes. So you instantly know as and when the prices of your shares change. On the other hand, the prices of the shares of privately owned corporations is not as transparent. This is mainly because the buyer and seller must agree on the price at which shares can be traded. This is usually done after looking at the financial reports and future forecasts of earnings and revenues and the boardroom discussions. This also makes valuation of investment very difficult. After these couple of points, you must be thinking, is there any benefit of having a private company? It is not that there is no benefit of having a private company. They also have some benefits. For example, they provide better accountability to their stakeholders. This is mainly because there are very few number of shareholders in private company, and with lesser number of people, contacting each other is easier. The management and the controlling shareholders are more accessible and hence more accountable to the minority and other shareholders. Next, since most privately owned corporations are early stage companies, they offer huge return potential to their investors once their business is settled and there is a good market for their products. However, on a downside, the risk of investment is also very, very high. These companies have good chance of complete failure as well. Next, there are fewer disclosure requirements for privately owned companies. For example, the requirements that are part of listing of shares on stock exchanges are not applicable to private companies since they are not listed on stock exchanges. Further, since private companies are not required to make quarterly disclosures, they do not have to worry about quarterly profit figures. Most public companies are required to disclose quarterly results. So, even if the results of one quarter are not good, sometimes to maintain the public sentiments regarding shares and their prices, the managers resort to manipulation of profit figures. However, private companies are not required to disclose quarterly results. So, they are not required to resort to measures to improve only short term profits. They can focus on long term returns. Now, the second factor based on which a corporation is classified as publicly or privately owned is issuance of shares. Public companies can issue additional shares in the capital market through IPO or underwriters, and then these shares can be traded in secondary market or stock exchanges. Private companies, on the other hand, issue shares through private placements. The terms of these placements are generally stated in legal contract document. The public companies may also make private placement of their shares subject to regulatory constraint in their respective jurisdictions. Investments in privately owned corporations can only be made by accredited or sophisticated investors. These are the investors who have a high appetite for risk that doesn't need regulatory approval and oversight. They do this by putting a limit on the minimum amount of investment that can be made or by specifying the minimum net worth or the assets required to invest in these companies. Next, we'll discuss the registration and disclosure requirements. Public companies are required to register with regulatory authority. For example, in the US, the public companies are required to register with SEC, that is Security and Exchange Commission. And SEC oversees and regulates these companies to make sure that they are following the fair practices. Like they fix the disclosure requirements, they make sure that there is no insider trading going on. They basically make sure that there is requisite transparency of information in the market. Public companies are also required to make certain disclosures, which include annual reports, quarterly reports, proxy statements, and additional disclosures regarding proposed mergers, acquisitions, tender offers, transactions by companies' insiders, details of beneficial ownership that exceeds 5% of outstanding shares, etc. All this information may affect the share prices of the company. The main purpose of these disclosures is to protect the interest of small investors. And you can find this information about any company on SEC's EDGAR system. Private companies are not required to make all these disclosures that are required to be made by public companies. However, they are required to file annual returns and in most cases the audited financial statements, which of course depend on the levels of profits or revenues they are earning. And they are not required to make all the information publicly available. These private companies can keep the information private if they want. However, if private companies want, they can disclose important information directly to their investors, but they are not obliged to disclose it. Meaning, they can, but the law cannot force them to disclose. Private companies mainly make disclosures if they wish to raise capital. Now, the next question is, how can a private company go public? There are three ways through which a private company can go public. They are initial public offering, direct listing, and acquisition. We will begin with initial public offering or IPO. Private companies can apply for IPO after meeting its basic listing requirements. There are some basic listing requirements regarding bid price, outstanding shares, lot size, market capitalization, total assets, etc. So there should be a certain bare minimum of shares outstanding in the capital or market capitalization or total assets held by the company to be eligible to offer shares through the IPO. An IPO also requires an investment banker. Why is investment banker required? To underwrite the issue of existing or new shares. These underwriters agree to buy a certain percentage or all the shares offered through IPO if they are not taken up by the public, and in return they charge a small fee. If the IPO goes through, the company goes public and its shares can be traded on exchanges. And the IPO proceeds can be used by the issuing company as capital. The next method through which a private company can go public is through direct listing. Now, what is direct listing? A direct listing is a process by which a private company goes public by selling its outstanding and existing shares to individuals and institutional investors by getting the shares listed on the stock exchange. These shares can then be traded on these exchanges. Companies that wish to get their shares directly listed on a stock exchange do not require the assistance of underwriters, investment bankers, or broker dealers throughout the process of direct listing, and there are no lockup periods either under this method. Direct listing is a very fast and cost effective way of issuing shares to the public. And so, the next way through which a private company automatically becomes a public company is acquisition. A private company can become public if it is acquired by a public company. And sometimes this acquisition is undertaken by a special purpose acquisition company or SPAC. These companies are also known as blank check companies. So, what is a SPAC or a blank check company? A SPAC is a shell company mainly floated to acquire an unspecified company at a future date. It is important to note that the investors in these companies do not know the company it will be acquiring, since the company being acquired is unspecified. So it is kind of a surprise for the investors, which of course may turn into a shock. Just kidding, the investors can guess about the company being acquired through the background of the executives and their media comments and so on. So these days there is a lot of information regarding personal and professional lives of these executives available. You know the companies these people are associated with and more likely to invest in. So the information is somewhat there. The money or capital is raised by a SPAC through IPO. So these companies offer share to the public and the public buys these shares on a blind trust. The proceeds of capital raised through IPO are put in a trust account. This money is only used to purchase the private company for which SPAC is floated. If the acquisition is not completed within the specified time, which is usually 18 months, the money is returned to the investors. And once the purchase or acquisition is complete, the private company now becomes public. Now, the next question is, how can a public company go private? Yes, this happens too. When a public company is tired of too much scrutiny or when they don't need a lot of diversification and control, they may opt for going private. One way for a public company to go private is that the investors must acquire all the publicly traded shares or the shares trading on the exchanges and delist the company from all the exchanges. To go private, the investors must pay a premium over the current trading price of the stock. This is because when the investors are looking to buy all the shares, suddenly the demand for the shares go up and hence the prices rise. Also, to acquire, they must offer a higher price, otherwise the current shareholders may reject the buyback offer. The investment required to purchase publicly traded shares is often raised through debt. The company might take loans or issue bonds, but sometimes there are enough retained earnings to carry on the purchases as well. There are usually two ways through which a company may go private: leveraged buyout or LBO, or managed buyout, that is MBO. Under LBO, the buyout is financed using debt, while in MBO, the investors use their money for buying the shares. Investors mainly decide to go private if they expect that the valuation of company after acquiring the shares at a premium will be more than the price paid for the acquisition. Otherwise, why would they even attempt a buyout? Usually, the going private of a company is accompanied by structural changes such as changes in management, restructuring of assets, etc. Not only that, but going private also puts the remaining investors in greater control, and the company that has become private is now under lesser scrutiny by overseeing authorities. The company that goes private can also go public after some years after the desired objective of the investors is achieved. And on how to go public, we already discussed the methods before. Moving on to the next question, what are some of the major trends in private and public companies? So, if we look at the data in developing countries, the number of public companies is increasing. This is mainly because these economies are often characterized by high growth rates, a transition to open market structure, and attract good amount of capital inflow. And since the companies are growing, they need more capital for expansion, which can be raised through stock markets. On the other hand, the markets of developed economies are more mature, and these economies have witnessed a high number of mergers and acquisitions. This has resulted in a smaller number of publicly listed companies on the exchange. Another reason is that these economies also have greater access to private equity and venture capital firms, which can provide greater capital at a lower cost. Further, a lower compliance and regulatory cost also makes private corporations a better alternative. Hence, a lot of corporations tend to go private in developed economies. Further, going private also helps avoid excessive control by the top executives controlling the corporation. Since there are a limited number of share owners, they have a good control over the affairs of the company. Moving forward, what are major types of corporate owners? Anyone holding the shares of a corporation is deemed as owner of that corporation. Major category of owners of a corporation include individuals, institutional investors, other corporations, government, non-profit corporations, etc. We'll now discuss a couple of these owners in detail here. Let's begin with the government. Government corporations are created with different levels of ownership by the government and other entities. For example, government entities may be wholly owned by the government or with some investment from other entities such as individuals, institutional investors, and other corporations, etc. In some government entities, government may be having a 50% stake and the remaining is held by private corporations, and in others, government stake may be 25% and 75% may be held by other corporations and individuals. Similarly, there could be various permutations and combinations of degree of ownership being held by the government and other entities. Government corporations have a regular structure like other corporations, consisting of a board of directors, management structure, etc. These corporations, like other corporations, also have a compliance and reporting requirements. The main purpose of these requirements is to provide transparency in reporting to external investors. Since the government has a holding in these corporations, it is financed from taxpayers' money. The auditing and other requirements make sure that this money is put to right use and towards the right objectives. For other investors, these requirements make sure that this corporation is also meeting its profit and loss objectives. In most countries, these corporations are set up to provide public goods and infrastructure facilities. For example, in most developed countries, government corporations are set up to provide facilities such as postal services, transportation services, etc. In emerging economies, they are also created to provide basic commodities and meeting energy needs like electricity, water, etc. In some countries, financial institutions like banks are also initially set up as government corporations and are then later transferred to private sector. This is done once the bank is fully operational. And the main reason behind privatization of bank and other government entities is that it brings more efficiency and objectivity to them. Some of the reasons behind privatization of government corporations are industry deregulation or technological changes. For example, in most countries, telecom and power industries shifted from government to private hands due to high level of speed of technological changes. The next is non-profit corporations. Corporations are also formed as not-for-profit companies, and these companies are not floated with mere profit objectives. These corporations are set up with non-financial social objectives along with the financial objectives. The money that these corporations earn is reinvested to fund the cause they were floated to serve. Now let's do a couple of questions based on what we've discussed. The first one says, which of the following does not reflect a primary difference between an IPO and a direct listing? A. Whether or not employees own shares in the private company. B. Whether or not new capital is raised. C. Whether or not an underwriter is used. Clearly, the correct option is option A. If the employees own the share, they can choose either way to go public. Both option B and C are incorrect because in the direct listing, only existing shares are offered and new capital is not raised. An IPO requires an underwriter, but for direct listing, there is no need for an underwriter. Moving on to the next question. A public company acquires a private company. What is the status of acquired company after acquisition? Is it A, public, or B, private? Obviously, once the private company is acquired by a public company, it will become public too. It will be managed by the public company, that is the acquiring company. That's all with this chapter. For detailed study material and practice questions, check out our website ProCFA.com and subscribe for latest videos and updated lectures. Thank you.